All right, for those of you who are patiently waiting, thanks for hopping on a little bit earlier. We're 2 minutes away from getting this thing started. And again, if we get up to 30 viewers, we will have another HT giveaway, which we have not had in a little while, but we're gonna get there. We're gonna get there. 1 minute and 50 seconds to go. All right, 13, 12, 11, 10 seconds until we're going to get this thing going. And we honestly, let's just get it out of the way right now. We're going to save 5 seconds, X out here. I think the notification may still pop up anyways. But for those of you who are joining us again on another Sunday night, thank you for tuning in and hanging out with us as we talk about the upcoming week in the market, recap our past week as part of our, weekly stock market scan series, game plan, whatever you want to call it. We still do not have a very catchy official name yet. Working on that, we'll get there. But before I just start rambling in circles, welcome. We had a really, really good week last week, but also the market had a really, really good week last week. The S&P 500 returned 6.63%, which I think is the single best week that it's had all year. And it came off the heels of two really, really bad weeks in the market because the previous week dropped 6.15%, and before that it dropped 5.05%. So it's one of those things where the market was down so much, we were kind of expecting a bounce, and that's why we got a little bit more aggressive with some of these positions, right? We had our DraftKings shares. We added cash secured puts at an 11 strike. We left about $1 plus of upside with 12.5 strike covered calls, and as you can see, those got blown through. But again, one of those things where that's a good problem to have because all in all from DraftKings, we made $3,300, and that is a win. Our Affirm and Roblox positions were fantastic. We've talked a little bit over the past few weeks about how we've been scaling into a lot of these different positions. So we started with 5 Affirm, 5 Roblox, kind of closer to being at the money, and those never really got into danger. With the idea of scaling in, we wouldn't want to adjust or add to these positions until it got below the break-even price. That never happened. So what the result was a pretty stress-free $1,200 of profit between those two. So you have it right there, right? We scaled in with the Affirm and Roblox. We had DraftKings right there. That's $5,000 of profit right there. $4,500 of profit right there. Don't want to oversell it. But, that's how quickly these things add up. That's kind of the approach that we're taking. And I will say our goal is always to outperform the S&P 500. We did actually underperform this week slightly, and that's only because it jumped up 3% at the end of the week, which, sometimes that happens. It is far better than the alternative had it dropped 3% on Friday, and a lot of these positions would have turned into losses. So, again, a good problem to have. If you underperform the market by 1%, but you do it on a week when the market is up 6.5%, that's not too bad. I'll take an $8,000 profit regardless of what happens in the overall market. But I think more importantly, contextualizing this whole conversation about us versus the S&P 500, us versus NASDAQ, if we go to our year-to-date summary, we're outperforming both, and we know that we're in this hole that we're in. We've talked about it before because of the mistakes that we made in January, which were position sizing related, and I don't think speak too much about any issues with the strategy overall. But as far as the long-term cash secured put strategy, we sized in way too heavily off the bat in a couple positions, and we paid the price for it. But that's how the market works sometimes. You're going to learn lessons. A lot of the lessons you learn are going to be expensive lessons. So for those of you who are watching, the idea is we spread that knowledge. We share the experiences that we've had in the market. So hopefully the expensive decisions we make prevent you from making those same ones in the future, and you are just the beneficiary of the profit that is reaped afterwards. Because after those first 3 weeks in the year, we've actually made a profit of about $10,000, and that's despite the S&P 500 going from 437 down to 390, which is about a 10% drop. And, more recently, looking at the month of June, we have a 2.69% return, which I guess includes this. So it's a little bit overstated, but about a 2% return in the month of June as compared to a 6% drop in the overall market. And we touched on this a little bit last week, but we want to avoid these huge red weeks. And I believe the way that we've adjusted the strategy puts us in a really good position to be doing that. Because if you look historically back in January, that's when the market dropped 7% and we lost $38,000. Now we are in a similar position where the market has dropped a similar amount over a similar time frame, and we're on track to make 6K. So the adjustments that we've put into place are working very, very well. I'm super happy with the way that we've adjusted the approach to fit the market that we're trading in, and I think we are well positioned, continuing this approach moving forward. And it's really well demonstrated looking at our performance against the S&P 500 and NASDAQ on the year. Because back at the beginning of May, we were trailing by a very, very decent amount. And if you look at the beginning of May, as we pointed out over here, the S&P 500 has dropped, NASDAQ has dropped. But since this midpoint in May, we've actually made $20,000 over a time frame when the S&P 500 has gone down. So I think that more than anything else is really, really great evidence as to what we're doing and how effective it is. So we're going to continue that, and let's quickly recap the rest of what we did last week so we can get into the important stuff, which is what we're going to be doing for the upcoming week in the market and how we're going to make money. But with Fubo, we split that position in half. We didn't really know what we wanted to sell. Because I think Fubo headed into the week was trading at about 275, which was halfway between the 2.5 and the 3 strikes. So we didn't really know what we wanted to do. The compromise that we had on that was that we were going to cut the position in half, sell half of the position as 3 strike puts, sell the other half of the position as 2.5 strike puts. Both turned profitable for us to come a profit of $600. We were assigned on the 3 strike puts because Fubo did not quite make it up above 3 by the end of the week. But that's no problem, right? No matter what, we still get this $480 of profit. We have 2,000 shares for next week, and we have a half-sized position, so we have tons of flexibility in case it moves against us. Bed Bath & Beyond finished dead on the number, and those shares were called away at the 7 strike that we sold, so we hit max profit of $660 on that one, and Bed Bath & Beyond is now out of our portfolio after bouncing. Open Door, another great example of us using that HT wheel strategy, riding these positions as they move against us, where we sold 35 strike puts for 37 cents a pop. Open Door finished above 5. In fact, it finished at 566, which is way up there. But regardless, we hit our profit target. That's another $1,100 of profit. Like up to this point, we've accumulated about $7,000 of profit over maybe 4 or 5 different tickers. And then that brings us to the SPX spreads, where we've seen a lot of success this year. If you look up here at this summary we've actually made about $6,000 on spreads this year, despite a very, very difficult market. And even though we lost money on the credit spreads this week, we lost $35. If you sum up the SPX one specifically, we lost $440. However, what I will say to that is the fact that, look, if you look at what we opened here, 1, 2, 3, 4, 5, 6 different bearish call credit spreads. If you have a bearish position via credit spreads on a week where the S&P 500 runs up 6.63%, you're probably going to get slaughtered. But because of the approach we've taken where we start small, when our long leg is breached, we immediately roll higher. We take profits when we see them. Right on 621, it stayed below, and this would have finished for max profit, but it was kind of in the ballpark. So we said, okay, first spread of the week, we'll take $150 of profit. We'll keep it moving. We'll roll up, we'll roll out, and that's exactly, what we did, and it paid off as we made $270 on the next one. And then we said, okay, we've taken profit that morning on 622, and then the market ran up again. We said, okay, you know what? Let's try again off this run up. And that's what we did. Same date, slightly lower strikes just because the market was further down. But it did start to threaten those strikes. And by the end of the day, this would have been max profit. But one of those things with these spreads, the last thing you want to do with these 0-day spreads is take them down directly to the wire and find yourself with a surprise max loss. Because we can recover small losses, right? I mean, 2 weeks ago, we struggled a little bit with these SPX spreads. But, the week before that, we made money off them. There was $1,300 made 2 weeks before that. And then the first few that we opened this week, we're decently profitable and racked up about $800. But you don't want to take max loss on these SPX 1-day spreads. That's rule number one. Do whatever you can to avoid that. Yes, you're going to have that trade where you regret it because, if I had just held it till expiry, it would have hit max profit. But, the difference between hitting max profit where you collect $1 of premium as opposed to hitting max loss where you lose $4 is very, very significant. And these trades all build on one another. So we said, you know what, we don't want to risk it. We're going to close for roughly a wash, right? We sold it for 95 cents. We got out for $1. That's a $15 loss right there. But we said, okay, the S&P 500 has gone up. Through this point in the week, we've sold 3 bearish spreads and we've made money. So we said, okay, you know what? Let's roll the strikes up. Let's roll them out. Let's do it again. And on 623, it worked. And we took home $400 of profit. And one thing you may notice is we slightly increased our position size to 4 as opposed to 3. That's just because the market had continued to move up. Really what we were getting at the front end of the week was kind of best case scenario with these SPX spreads. Because the way we set them up is that, yes, they're bearish. We want the market to go down, but we sell them a little bit out of the money so that if the market goes up a little bit, we can still make money. And that's exactly what was happening. Best case scenario is the market goes up a little bit, all of our other positions go up, and it just stays below these strikes, so we hit profit everywhere. And that happened right here, which was fantastic. And then we said, okay, headed into the back end of the week, let's just sell one for Friday for $38.40, $38.45, relatively similar. In fact, we actually rolled up our strike by about $5. And we said, okay, let's let it happen. And then on Friday, spoiler alert, where's SPY down here? I don't have it, but SPX up 3.06% in 1 day. That is not going to happen a lot, but again, reality of trading, it does happen. So we followed our typical strategy, right? The second that long leg was breached, we rolled up, we rolled out. And so we were able to close for 265. We rolled up. We didn't roll out because it was still early in the day, but we rolled up to 38.80 to try to recoup $1 of premium. And full disclosure, I was a little bit busy Friday, so I didn't quite see this one when it broke through the long leg. Otherwise, I would have been able to close out of this thing for 2.80 and roll up and out to Monday. But since I was busy, and the great thing about our strategy is, you can be busy and things won't completely, set on fire or melt down. But I was a little bit busy, so missed out on this, maybe on about $300 right here by not being glued to the computer right when it breached the long leg, but closed it out because it was a Friday. I didn't really want to hold anything over the weekend. I said, it sucks that on Friday our credit spreads lost us $1,200, but the result of that is that we lost $1,200 because the market was up 3%. And when the market's up 3%, what happens, right? Open Door runs up 5.2%, DraftKings runs up, Fubo runs up, Bed Bath & Beyond runs up and gets to our call strike. CLF, which was a losing trade during the entire week, ran up and made us $420. So the benefit that we got from our other trades far outweighed that little $1,200 loss that we had at the end of the week. So yes, we did lose on the spreads, but in a sense, since they're directionally a little bit different than the bullish positions we have in our portfolio, it's a very nice little balance. And while Friday may have seemed like a disaster because, when you're just dead set on your SPX spreads and ignoring the rest of your portfolio, it's like, oh my gosh, these are leaking money. But at the end of the day, it all kind of balanced out. We finished up the week with a profit of $8,000. We're making money overall in June, which is our goal. And that's really all we can hope for when the market is having such a poor stretch. So we're winning. I'm not upset with that, and that's perfectly fine. Revlon, the 1013 strike covered calls. This is an example for those of you who follow us and are familiar with our IV reversion strategy. You'll probably know that the IV reversion strategy is typically one which is based off of a bullish position where it spikes up and you say, okay, I don't think it's going to fall all the way back down, and the big spike has given me a decent amount of option premium to sell. However, when you get these alerts in our Discord server, we're going to talk about this really quickly, in our IV reversion alerts channel, you get a little 52-week range right here, which shows you the range that the stock is trading in. With IV reversion alerts, we love it when it's at the low end of the range and we can make a bullish trade and say, okay, we're kind of near the bottom, so we could get a decent credit. However, when we see stocks that pop up and that they appear in the high end of the range, which I'm trying to find Revlon specifically here, but I don't know if I'm going to be able to do it off the live right here. But either way, let me type in Rev really quickly and see if I can find it. Come on, come on, come on. There we go. There's the message. So what we see here is Revlon, which is a company that we know from following price action and following some market news that they have declared bankruptcy. And what happens a lot with bankruptcy is a lot of people pile in with short positions because, look, the company's bankrupt. It makes sense that they're going to continue to go down. And what's kind of crazy when things like that happen, and this happened really, really similarly with Redbox, and we have a video on our account about Redbox. But for example, Redbox was subject to what's called not a takeover, but a take under, meaning that they were going to be acquired for less than their worth. So what does that mean? That's the green light for people to jump in with short positions. And if enough people jump in with short positions, you see the impact that it has on price movement. You get these random big squeezes. But again, just because something's squeezing up as a result of high short interest doesn't mean that it's worth that much. So it's really easy to short. However, you get blown up with just like a naked short or something like that. So what we do is we play them back down with call credit spreads, which are a short position, but they also present themselves with defined risk. So we're not going to, crush ourselves if it runs up. So with that said, the same thing happened with Revlon, right? We got the alert in our Discord server from the bot that we've set up, and we noticed that the price was $874. But the 52-week range was 108. And yes, the high was 1765. So you definitely want to keep that in the back of your mind. But looking at the recent price action of Revlon, if we type in REV here and bring it up, there you go. You'll see on the 180-day chart that 17 spike was really the top end of one big candle wick. And it historically had traded around the 10-ish level before going down to 1 after the bankruptcy news and then popping back up. And again, why did it pop back up? The answer is because there was just a ton of people piling in as shorts off the bankruptcy proceedings, right? If a company's here and they declare bankruptcy and drop down here, fundamentally they shouldn't be worth more than this point in this short of a time period. I don't think anything fundamentally has changed about their business. It's just one of those weird little things you'll see sometimes when a bunch of people are piling in to short a stock. So with that in mind, we looked at the 180-day chart. We saw the range that was presented in the alert. It's near the top end of the range. There's a lot of downside to 1. Again, looked at that chart. We saw that it had been trading around 10 a share. So we said, okay, let's set up a call credit spread bearish with a 10 short leg and a 13 long leg. And we were able to get a 5 or 50 cent credit for that, meaning at max profit, if Revlon finishes below $10 a share by July 15th, we're going to bag $500 of profit. Now, what do we know when we opened it this past week? If you look at the calendar, right, this week there's 1, 2, 3 weeks until expiry on that credit spread. And I'll be the first to tell you, we saw it with Redbox a little bit. Just because these things fall back down predictably, it doesn't mean that the battle is over, because they can irrationally spike up just as quickly. So if we see that we can collect a decent bit of profit off the bat, we absolutely take that. When we sold the Revlon 1013 the credit spreads, we put an order in immediately to close them out for 25 cents. Because that means even though it would have, if we held till expiry, been a 4 or 3 week trade where we would have collected potentially 100% of max profit, we could have gotten out in less than a week for 50% of max profit, which, if you follow the linear collection of profits, far outpaces that. So if we can get out for 25 cents next week, we are also going to take that opportunity because, not only do we lock it in ahead of schedule, we also take all the risk off the table, because if it decides to shoot higher up to 12 or 14, then we could re-enter and be just fine. But, that's the value of getting these alerts, knowing what's going on in the market as it's happening, because these can be pretty quick trades. And again, these are the charts you'll see on a lot of those opportunities that are called out, right? A big spike in implied volatility. And while typically for IV reversion, we like those spikes in implied volatility because they could allow us to sell premium on bullish positions, it works just the other way, because that premium is also available on the call side for you to create a short position with. So that's something that we're going to keep our eyes on. And for those of you that are in our Discord server and are able to get these alerts, you'll notice that there have been a few per day, and they could get a little bit crowded in here. However, I did a little bit of work this weekend, and we should now only be getting alerts on stocks that have expiries within the next 14 days, stocks that have volume on the options, and stocks that have options that are either at the money or out of the money. So we've made some improvements to this IV reversion bot. So we should be able to have some really, really good results in there this week. So that's going to be a great place to keep your attention focused on if you're signed up for those alerts, because I think we've got some really, really nice opportunities there. So with that said, let's pop back to our profit tracker and round out the week. The Zen, the 58 strike put, is a great example of why sometimes it's easy to get regretful when you enter into a option selling trade like this, because this thing fell off the face of the earth. I think we originally played it at like 70-ish, and it kept falling all the way down to mid-50s. I sold something like at the money this week for about 280 of premium at 58. But as you can see, there was a massive green candle from the announcement that they were actually going to be taken over at about 74 shares. So you could have said, oh, HT, this sucks. Like, if we had just taken shares and not covered them, we would have made all of our money back. Which, yes, that happens. I'll be the first to tell you that's one of the downsides of the strategy. But how often does this happen? The answer is not very often. And, we should never bank on price movement like this. Even, over the past 180 days, you can see what more typical price movement is, up and down with shorter candles, building moves, throughout the last 6-month period. But again, a little bit of FOMO, but we pulled $280 of profit off that. We can't be too mad. CLF, that 16.5 strike put, which was previously at the money, I believe, when we sold it, just finished in the money. So I woke up Saturday morning to find out that we had been assigned on those shares. So we have 1,000 CLF shares ready for us to sell covered calls on Monday morning, tomorrow morning, once the market opens. And I'm thinking I'm going to be targeting 17 strike, because I guess I'll talk about this in just one second. SoFi finished worthless, and we rolled those to next week. Same strike, keeping the trade moving. SoFi is going really, really well. Even though the stock's down 34.44%, we are in a position where, as long as it stays above 6 this week, we're going to be making $1,000 off of it, despite the fact that over a 3-month period it's dropped, it's a third, which is crazy. But there we go. That was last week. We pulled $8,000 of profit. Yes, it was a great week in the market as well. We slightly underperformed the market, which we always hate to do, but I think the one exception to that is when something like this happens. But now let's talk about that move in the market. Let's talk about that 6.63% spike that we saw from the S&P 500. What is the significance of this? We saw 2 big red weeks before it. I think you can probably find timestamps of me last week saying I was expecting a big bounce. This was the big bounce. So now the question is, where do we go from here? Now, I'll be the first to tell you that everything that we are about to say is relatively speculative. And if I really knew where the market was going to go, I'd be all in on some sort of credit spread or leverage position, and I'd be living on an island somewhere. But unfortunately, none of us can predict the future, so we try to make the best educated guess we can and set ourselves up with a portfolio, that supports those educated guesses while leaving us a little bit of cushion in case that we are wrong. But with that said, huge bounce in the market on a 180-day basis. RSI is back in the red. What happened the last time that we had a big bounce on the 180-day basis and we saw RSI get up into the red? That would be back at the end of May, when we got back up to that 417 level, and the sentiment for a little bit, over a 2-ish week period as we bounced between 408 and 420 was, where's the market going to go? Is the worst behind us? I tend to believe that the worst is not behind us. I am subscribed a little bit to the theory that the market kind of goes as the Fed goes, and as they begin tightening the balance sheet and continuing to increase rates, sometimes, in amounts in excess of what has been expected up to this point in the year. But I really don't expect things to magically get better. And you'll notice there's a couple areas right here at the middle of May, end of May here, where we bounced at like the 388, 389 level. And that's exactly where the market finished at the end of the day on Friday. So I think this should at least preliminarily act as a point of resistance, and I expect us to move further down. Now, how far down? That is tough to answer, quite honestly. We initially had this 361 level identified, and it bounced off that pretty nicely, to be honest. But I think this could be where we head off resistance and we move down potentially further from here. I've seen a lot of people calling for 3,500 on SPX, which would be the equivalent of going down here. But the point is, things aren't magically better in the market. There's still some huge issues, both on an economic basis and the people who are pulling the strings with the Fed, where I am cautious of where the market is heading going forward. So we're going to continue that cautious approach. And what that means is when the market goes up 6.63%, we want to be in positions that are much smaller than normal and allow us flexibility in case the market continues to drop. Now, what you'll notice if you've followed us and watched these streams from time to time is that this is the smallest amount of positions that we've, I think, ever really had headed into a Monday morning. In fact, this is only 52.39% of our money fully cash secured. We like to be in that 80-90 range, which leaves us flexibility to double down up to past 100, I guess. But yeah, point being, very, very small amount of positions headed into Monday. So let's first talk about those positions. DraftKings, we rolled up for a debit, which went. You never want to roll for a debit, obviously. However, we're only doing it because we made a ton of money and DraftKings ran through the 12.5 strike we sold last week. So we sold 13.5 strike for this week. And what do we know about in the money covered calls? They're basically the same thing as selling an out of the money cash secured put. So I want to continue to be cautious. This is the equivalent of me selling a 13.5 strike put, where if I didn't have any money in the market at all and I wanted to initiate a position on DraftKings, this is what I would have gone with. So that's the strike that we went with. Sucks that we rolled up and out for a debit because that does temporarily increase our break-even price, but by the same token, we're also increasing the potential gain on the shares by rolling our strike up from 12.5 to 13.5. So give and take, you're not going to lose by doing this because you took a 57-cent debit and rolled the strikes up $1. So there is a net benefit of about 40-ish cents that we're going to be getting. And you can see at max profit, there you go, 860, which on a 2,000 share size position means that net benefit is 43 cents. But, any little bit is progress towards getting back to our eventual goal, which, as we've outlined several times, is getting this position back to break even, which is getting closer. And this is inaccurate because this needs to be a number. So I think we're closer to a $4,000 or $5,000 loss in this position. But, the catch, so to say, is that, it's okay that we're losing $4,000 because this stock has dropped 60% on us in the time that we've been playing it. Our break even price is around 15 a share. We are getting very, very close to that light at the end of the tunnel that we talk about every single week. The strangles that we've entered into have been effective. I think the three, of 29 cents, 20 cents to get us to 50 cents, and then add 37 cents. That's knocked 87 cents off of our break-even price. So the strangles that we've scaled into on this one have been very effective. We're not in a strangle right now because if DraftKings drops down to 13.5, guess what? We're still making max profit on the week, so there's really no need to touch the position yet. Our break-even for DraftKings this week is 12.56. So long as it stays above that, we're going to be looking just fine. So let me think that through really quickly. Yeah, no, that looks about right. So again, game plan here. As long as it stays above the break-even, there's absolutely nothing that we need to do with DraftKings. Same with Fubo, where we have 2,000 shares, and they're uncovered right now because we were assigned those at market close on Friday. Probably just going to sell the 3 strike covered calls, right? This is a more conservative position, but what it does is this is the price that it was trading for at market close on Friday, so potentially what we could expect to get for it on Monday morning. But that 13 cents of premium, that's $260 that we're going to get no matter what. We get 5 cents of upside on those shares, which isn't phenomenal, but also speaks to the fact that premium might be dying out a little bit on Fubo, so might be time to take our money somewhere else. Opendoor, still love the premium that we've got on there, just keeping the ball moving. Even though we had 5 strike puts that expired worthless last weekend, we had to roll the strike up. I think there's still fantastic value at this 5.5 strike, so I'm sticking with it. And now what we do notice about when we roll the strike up, because this is a point that I think is important to make, because people can get kind of iffy about rolling strikes up, is that in the overall view of the position that we're in, right, we had a 5.10 break-even price last Friday. However, we couldn't hit that because we were capped at 5. So it was one of those things where our break-even price, technically, mathematically speaking, was 5.10, and our profits were capped at 5, so we couldn't hit it. There'd be a 10-cent difference. When we roll up to 5.5 strike, it actually increases our break-even price, right? Because we get a 25-cent credit on what we sold, but the strike price is 50 cents higher. So our break-even price actually moves up to 5.42. But again, I'm okay with that because in the scheme of things, Opendoor's dropped 20%, and we're in a position where as long as Opendoor finishes a 5.50 or above this week, we're at an overall profit on the trade. And if you're making money on a trade where the stock has dropped 20%, if you're making money on a trade where the stock has dropped 34.44%, you have an effective strategy, and that's a strategy that is going to be a winner in the long run because you could handle
this type of volatility and these types of downward moves in the market. But again, full capacity with Open Door as demonstrated back on 6/17 when we opened 4 different sets of cash secured puts. I would consider 40 contracts here to be a full position size. So by having 20 contracts heading into this week, we get that much desired flexibility to where if Open Door moves against us and drops below 525, no problem. We'll sell 25 strike puts and we'll be right back in the game, lowering the break-even price further and potentially taking assignment at a very favorable price for the stock. Moving down, we've still got that Revlon 1013 call credit spread that we talked about. Going to be aiming to close this one out for 25 cents so we could bag about $100 of profit on it next week. CLF shares that we were barely assigned because it finished 2 cents in the money last week, but that's all right. There's a decent amount of premium on these. I do think that the stock is going to come back up. We could take a look at the chart really quickly because I was reviewing it earlier when I was trying to figure out what strike I hypothetically wanted to sell these things at. And what we'll notice is that back here in about, the end of January, we had a really nice bounce at this 1650 level. Well, we're back at the 1650 level. It looks like we've started to bounce thanks to the green day on Friday. So I want to keep a little bit of upside, but at the same time, IV right now on CLF is very, very high. Decent amount of premium, so I'm not going to get too greedy, right? I don't want to get too greedy. I'm going to take 39 cents of premium. That's $390 for us no matter what, and at least 52 cents of upside on the shares, which on a position size of 1,000 shares means we have $520 of upside on those CLF shares should it finish above 17 next Friday. And again, this is about a full-size position for me on CLF. We started playing this thing at about 21 and it dropped very, very quickly. And I don't really want to allocate much more than 10% of my portfolio to this position. So I will not be scaling any further. Whatever happens, happens. And that's part of the reason why I took, the closer to the money covered call, giving me more premium. And then the very last thing we have, SoFi, 6-strike put. Very, very easy, brainless decision basically to have these things expire worthless last week for $740. Roll them to the exact same strike 1 week further and potentially bankroll another $420. This one has been fantastic for us. As far as following the process of the HT wheel, we saw with Open Door that it bounced back up and our break-even price had to jump back up a little bit. But with SoFi, it's been pretty easy. We've rolled relatively similar strikes from week to week to week to week to collect premium over and over and over again. And it has led us to a path where our current break-even price on SoFi is $5.50, which is 41.18% below where it started. So due to the fact that SoFi is only 34.44% below where it started, we are in line to make about $1,000 overall on this trade so far. And I think this may be one, we always talk hypothetically about the fact that you can get to a zero basis on a position. And I think that I want to try that with, one of SoFi or Open Door. So I may stubbornly continue to roll some of these cash secured puts until we get our break even really, really low. But these are 2 good candidates for it. They've been 2 good trades so far. Yes, because the stock has moved against us, it's not great. But thanks to the amount of premium we've identified, these opportunities that we found, we have resulted in a profit overall on those 2 trades. But that's about it for what we have. So I think there's a really interesting discussion to be had because, you'll notice that our 2 money makers over the last few weeks, Affirm and Roblox, which we've just mindlessly been selling 5 at a time with. And I think if you add these up, Affirm and Roblox, let's see what we've gotten from these things over the past couple weeks. $2,500. If we add this up right here, it's now up to $3,500. Had a loss there to drop us to $2,700. We've got Affirm and Roblox again. So basically, since the end of May, Affirm and Roblox have made us about $6,200. And that's off them, not really doing anything too crazy until last week. But to that point, last week was only $1,100 of profit of the $6,000. So it's not like we only made money because of what happened last week. We've been making money the whole way that they've been bouncing up and down. Now with Roblox, we talk about this one almost every week, but I think it's at the point where it might be time to temporarily leave it alone. RSI is above where it's been in the last, it hasn't been this high since December, which is before we were even in on the trade. So with Roblox, I really don't want to touch it until it comes back down because we've seen what some of these red candles look like. We've seen how vicious some of these red candles can be. And even on a 180-day basis, look how high this RSI is, 78. We want nothing to do with that. Look at the last time RSI got to this level. Looks like it was right around here.
in March 18th, and that's when it was trading at 50 a share, where it leveled off and then fell back down. We could go to another time where it got this high up into the red. That would be back on November the 22nd, where it got up to 141, and there was almost immediately an enormous red candle to take it down to 115. So this is one that I definitely like the idea of continuing to trade, because implied volatility is falling off a little bit, but that's what happens when you see some green. If we see another slide like this, you'll notice that the slide on the chart from the stock price perspective coincides with an increase in implied volatility down here. But if we do see another slide, that's when it's going to be one that we say, okay, let's go back to the mid-20s, let's sell something. Because right now, you could get 1% ROR down at like the 31 strike, but even the 31 strike, I just don't know if I'm in love with that, considering where it's traded over the last 20 days, right? Even just what date is this? June 17th, which is less than 10 days ago. This thing was at like 24. So jumping back in at this level is a little bit questionable, especially when you're only generating like a 1% ROR. Because when we scale in, we want to actually take a little bit more than 1%. And we can talk about that in a minute when I talk about some of the other trade ideas that I've got for this week. But that's the reason we don't have Roblox on the roster for this coming week. But let's talk about Affirm, because this actually might be one that I add back for the coming week. Because yes, it finished plus 7.48% on Friday. I think the business is actually positioned to do decently. It's jumped up from 16.4 to 23.38. However, less than a month ago it was at 31. So still relatively in between those two price levels, as opposed to Roblox, where it was kind of breaking a little bit higher out of those last 2 or 3 months where it's been trading. So I think there's a little bit more upside on Affirm and a little less downside on Affirm more specifically, because if we zoom back in on that the 20-day basis, we've got a little bit of a base in the low 20s, even more so right around 18 or 19. So we could conceivably try to sell some cash secured puts for July 1st at that level. And if you take a look at that level, at 19 you get 1% RR. And we mentioned when we scale into positions, we want a little bit more than that. So what we could probably get away with, if you look at the MMM right here, it's 1.85, meaning that's based on Thinkorswim, TD Ameritrade's hypothetical formula that they have that predicts predicts price action. It predicts a range of that. So the expected low end of the range on Affirm would be 23.28 minus 1.85, which is like 2160-ish. Someone maybe check my math there, 2140-ish. 2140, final answer. So that falls right around here, 2140. And, I don't hate that. I mean, with how volatile Affirm has been, there's not really a nicely established area of resistance or support. So we're kind of in no man's land, but we're in no man's land on the low end of the 180-day basis. Yes, we could probably see high teens again, but if we start a trade-off at like 21.5, if we basically go right on the number for the low end of the range and sell 5 of these things, 21.5 minus 0.7 gives you a 2080 break-even price off the bat. So what you're looking at on a 5-day trading basis is that as long as Affirm stays above, what was that again, 21.5 minus 6, so 20.8, and if I could draw this on here really quickly. So as long as Affirm stays above 2080, which is this line right here, can it get back down there? Absolutely. You've seen how volatile it can be on a 5-day basis. But, the odds are decent. We've got this probability out of the money, which is a great tool that Thinkorswim offers to help you identify the likelihood of certain trades working out. So we know that anything above 2080 is something that we would make profit on. That 2080-ish level has roughly between a 75 and a 71% chance of finishing out of the money. So about 7 times out of 10, you're going to make money on this trade, and those are fantastic odds. And in the event that it's one of those 3, we scale further in. We lower our break-even price further, we sell lower strikes, and keep moving the odds in our favor. So by the end of it, once we've fully deployed all of that capital, we have a very, very nice break-even price and a very, very high percentage chance that we've made money on the trade. And those high percentage trades are exactly what we'd like to target and jump into with our option selling strategy. And it's how we've weathered the storm so well in June so far. Despite these huge drops in the market, we've still had some big-time winning weeks. We've held our ground when the market's gone red, and then saw the benefit of staying patient and scaling in last week when we took home an $8,000 profit once the market bounced, and kept us positive in June despite a really, really bad month so far on the S&P 500 and NASDAQ. And it's kept us outperforming on the overall year. And since we've kind of adjusted the strategy we're up $20,000 over a roughly 1.5 month period, where the S&P 500 is down like 10%. So that's been fantastic for us. But that is probably going to be what we target with the firm, the 21.5 strike, because if you take the math of the 23.28 current price of the stock, subtract that 1.85 expected move, that's roughly where it puts you. That gives you a 3.39%-ish return on risk, which is not too bad for 1/3 of a position, right? Because if we know that 5 contracts is what we're going to start with and 15 is our max, those 5 contracts are 33%, or 1/3 of our full anticipated position size. Now, we like to target 1% ROR each week, but if you have a 3.39% ROR on 1/3 of a position size, that's the equivalent, since it's 3x of 1, of getting 1% ROR on the entire position. So actually, by starting smaller, not only does it make us a little bit safer on the front end of these positions, it also allows us to get that entire benefit that we look for with that 1% ROR without taking the entire risk of putting our full position into a trade. And I think that is going to be the way we go about this market, especially as volatility remains high and we see these crazy ROR numbers right around where the stock is trading. So a firm is something that I'm going to want to add to the portfolio come Monday morning. And there are a couple other options that I want to talk through as well. And I laid out a little bit of this in the Discord server earlier, so I'm kind of just going to drag this onto the screen to lay out the conversation and kind of guide where we're going to be talking. So one of the stock scans that we like to run is high premium oversold stocks, because we talk a lot about RSI. We talk about trying to time things when they're bound to bounce instead of chasing things at the top. That's what looking at low RSI accomplishes. And when you look at high premium, high RORs, you've got options that offer really nice premium, which give you very, very attractive basis, very, very attractive potential returns. So basically, this scan gives us a list of those high ROR options, which give us nice returns, but only looks for stocks that are oversold with those parameters. And this is the list that it gave us: MRO, MSOS, OLN, MT, and PBR. So MRO is an oil company, and I'm basically kind of just going to be reading off of the screen for the research I did earlier today. But MRO is an oil company. The energy sector is getting slammed right now. We're seeing a lot of rotation out of that sector and into other areas. And because of that, I am going to be staying away from energy. Now, MSOS, the next stock that comes up on there, is a lot more interesting. Here's the 3-year chart, and it's a cannabis ETF. And I've always been a little bit intrigued about the idea of having some sort of cannabis-related investment in my portfolio. And while over the last 3 years, this looks like a terrible investment to have in a portfolio, looking at it today in June of 2022, this looks like a decent spot to potentially enter into MSOS. So step 2, as we follow that logic, is okay. What do the options look like? And again, implied volatility is relatively high, so the options are probably offering really, really nice premium. And these screenshots might be a little small, so let's just pull it up on Thinkorswim here. MSOS, we take a look at that option chain, and we see things that we really, really like, right? We see that it is weekly options, meaning we have a lot of flexibility on a week-to-week basis about strikes we want to sell. If we need to potentially roll positions, there's a lot of strikes. And if I change this probability out of the money column to a volume column, we'll see that there's actually volume on these options as well. And the ROR is exactly what we like to look for. So we've got a really, really nice setup right here, right? We've got a stock with RSI kind of in the gutter, and this is on a short-term basis, so let me back this out a little bit to a year. But there you go. On a 1-year basis, you have a stock where RSI is kind of in the gutter, it's in the blue, and anytime it's in the blue, the thing's either begging for a bounce, or if we look at the last time it was blue, it didn't necessarily bounce, but what it did was hang out around 14 for, about a month and a half. And again, with these cash secured puts, the great part about these trades is we don't really need these things to skyrocket back for us to make our money. We just need them to not really go down too much. So if we sell something like a 10.5 strike put with this low RSI, and even if it continues downward, just as long as it doesn't drop 80 cents, we're going to bag max profit on that. And it's looking like it was trading between 10 and 20 cents, so we can maybe conservatively call that 15 cents of option premium. That's going to be about, there you have it right there, 1.45% ROR, which is exactly what we want for the course of a week. So if we sell 10 of these puppies, that's $150 of potential profit for the coming week. That's how you start to load your portfolio up, put together these base hits that come together to give you a really, really nice successful week and an overall win, right? We're not going to make or break our week on one individual trade. we may have trades that do really well. We may have trades that do really poorly. But the idea is we have enough diversity in our portfolio between strategies, different stocks, and trades that, one thing's not going to kill us. And now one thing isn't going to make our week, but, these things are high percentage trades that build to make our week. So what I've identified here is I really like the 10.5 strike. Why is that? We talked a little earlier about the MMM, the market maker move. It's 65 cents for the coming week. So 65 minus 11.34 is roughly like, 10.70-ish. Don't quote me on that. I think that's close enough mental math. But yeah, 10.70 is above that 10.5 strike. So you're selling a strike that's below the low end of the expected market maker move, meaning that mathematically you've put yourself in a really nice position to potentially profit. And you've done so at a very favorable ROR on a strike that has volume. So you might be able to find that trade. And again, tons of call volume on this side too. So people are potentially equally bullish on this ETF. So I'm a fan of holding on to this thing at potentially a 10.5 strike. So that's what I will sell for the coming week. MSOS, July 1st expiry, 10.5 strike. OLN was the next one on the list. And we have the 180-day chart pulled up right here and thrown in the chat. Interesting one because it's a lot like some of the stocks we looked at earlier. I think CLF specifically, where you look at the 180-day chart and it's down at an area of support and you're saying, okay, this is probably a really, really nice area for this thing to bounce. And the question, why do we like to look at support so much? Right here is probably your answer, right? Because this thing was free falling from 67 down sub 50. Where is it going to stop? If you looked at the 180-day low and saw that it was 44.24, and use that as a point of reference, you probably would have nailed this little bounce right here. But with that said, you zoom the chart out, you continue the process. Here's the 3-year chart. There's just way too much potential downside for me. I don't know a ton about the company. I don't think the volume was fantastic or anything like that. But it's just one of those trades where, it probably would work, but I'm not in love with it. And there's so many different stocks. There's so many different options, so many different potential setups out there that if you're not in love with the trade, there's really no need for you to go in on it. So moving further down the list, this wasn't on the list, but as I was going through my research, something popped into my head, was ZIM, Z-I-M. Let me see where I start the charts on this one. So this is ZIM right here. This is the 3-year chart on ZIM. As you can see, it's run from 934 to 9123 and has since fallen, almost basically been cut in half down to 46.35. And you may say, HT, you just ruled a stock out because it had, kind of a lower base. And what I like about this one is, if we bring up that other chart, the run up here is a lot steeper, right? You see this support at like the 40-ish level, and then where's the next time that the stock kind of chills out, so to speak? It's right around the 20 level. So in my mind, there's a decent gap between 40 and 20, which means I think I'm taking on a little bit more risk than I need to. Right here at 46, we see some decent support along this line. The next bounce was around, mid to high 30s. So I think we have multiple levels of support here, even though at 3 years ago this thing was trading, or, the beginning of this time period was trading at 934. What they do have is that they pay a dividend as a stock, so it's a decent from an investment perspective. And the other thing that's nice is that they're making money. They're doing very, very well from a fundamental perspective, and that's what fueled this run in the first half of 2022 before, falling back down. So with that said, let's take a look at the option chain. This is what it looks like. You can get that 1% ROR number at 42, and I think, let's see right here, it closed at 46.35 on Friday afternoon. The MMM's 2.16, meaning the low end of the expected range is roughly around 44, and 42.57 is the 180-day low. So right in between those, 44 low end of the expected range, 42.57 being the 180-day low. I was a big fan of the 43 or 43.5 strike option. Right? Because if you sell a 43 strike put or you sell a 44 strike put for 90-ish cents, your break-even price is going to be 43.10. What's the odds that it finishes out of the money? And we've got that circled right there. We brought that in earlier. There's a greater than 70% chance that you're going to be a winner on that trade. And I think what I eventually settled on was like 45 strike put, because those are going for a little bit more. And remember, we talk about scaling into trades where with a firm, we could enter into 1/3 of our position, and instead of targeting a 1% ROR with the entire position, we could target 3% or more with 1/3 of the position and achieve a similar result as far as profit and loss is concerned, while taking on less risk. So ZIM is actually very, very similar in the way that I view that. So if I click in here and type in ZIM, we've got the option chain up right here. 45 slightly out of the money, but I think out of the money enough, right? Because we see that 43 or 46.35 minus the 229 market maker move puts the low end at about 44. And if you sell a 45 strike put, what do we know about strike minus the premium you get? The 45 minus about the $1.30-ish of premium means your break-even price is going to be at 43.70, meaning lower than this range. And again, back to that screenshot we had right there, the odds that it gets down to 43.50 where you start to lose money, are only 30%. There's a 70% chance this finishes out of the money. And even if it does, what do you do from there? You've left cash on the sidelines because we're scaling into a trade that offers 3%. So theoretically, you still have 66% of your potential capital that you would like to allocate to this trade ready to go on the sidelines. And that's when you would start to throw it back in and lower that break-even price, bring in more potential profit, and keep moving from there. I think it's a very, very nice setup at that 45 strike. So that's another item that's going to be on my shopping list, right? We've got the what was the ticker we just talked about? MSOS 10.5 strike put. I like the Affirm cash secured puts that we talked about earlier, and then I like the Zim 45 strike put that we just talked about right there. And I think, in the spirit of being careful and being cautious, I think having 3 that we're going to add to the shopping list right here, because if we let's model this out really quickly, right? We know we've got Zim. We know that we want to add MSOS. And we know that we wanted to add Affirm. And if we add, let's put the quantities in there as well. So we wanted to sell, 5 of Zim, about 15 of MSOS, and then 5 of Affirm. And if we're selling these things for Zim, a 45 strike put for $1.30, that's going to be right here, $1.30. MSOS, we know those were going for 15 cents. In Affirm, let's pop back to that option chain quickly to get an idea of what these things would go for. What do we say? 22, 21.5. I like 21.5, 3% ROR with a third of a position. So those go for about 70 cents a pop. So we'd throw 0.7 in here, and then we could just copy down our formula for calculating gain or loss on cash secured puts that we sell. And we'll see that from these quantities, with these 3 trades that we're potentially going to add to the portfolio come Monday morning, we've added a potential $1,225 to our max profit, which if you combine that with our current base profit of $24.30, gives us a $36.55 base profit head into the week. Again, with what I think is minimal risk, right? We've got a smaller DraftKings position. We have a half-sized Fubo position, relatively conservative CLF position with the 17 strike covered calls, and then Open Door and SoFi, those have been cut down as well. So adding these into the fold, where the great part about this is, this is a cannabis ETF, kind of independent of anything we've currently got. This is a shipping company that's independent of anything we've got right now. Affirm is kind of in the financial payments growth area. I'll be the first to tell you that's kind of similar to SoFi, but I like the way that the premium sets up right there. So we've got 2 positions that add diversity, a third that we love the value on, so we're happy to continue trading. But again, this is how you identify these smaller positions, start yourself up with lower risk positions, lower risk sizes, while still managing to add a significant amount of profit to your overall week with $1,200 of potential profit right there. And, I think that's a good way to start Monday. We've seen some very, very volatile weeks. Hell, we've seen weeks on Monday and Tuesday where the market runs up and we're like, oh man, okay, this week's over. We win. And then, come Wednesday, Thursday, things have fallen back down and we've gone from a gain to a loss in a week. Now that's a lesson we've learned, and it's why we closed Roblox for 14 cents last week, very, very early in the week. So I don't anticipate we're going to get crushed by that type of a move. But it's definitely something you want to keep in the back of your mind. So these are good options right here. I also want to continue to open these bearish SPX credit spreads, so that'll add another 300 or 400 off the bat to get us to about $1,500 of potential profit in trades that we are aiming to open tomorrow morning, and that'll get us to about $4,000-ish, right? 36.55 plus 300, yeah. So that'll get us to a $4,000 base return for the week, which I think is phenomenal, especially with what I feel is a little bit lower risk in what we're holding. So that's kind of what we got, right? We've got what we got. We identified 3 potential trades we want to add. We want to keep an eye on Roblox in case it comes further down because the market has been insanely volatile. Things go up, things go down. We also want to keep an eye on what should be the new and improved iView reversion alert channel. Should have some much, much better options there. And I think those are very, very important to add up on, or to load up on, when the market is like this. Because what we know about these IV reversion type trades is they're relatively disconnected from the overall market. So if the market has just jumped up 6.63% in a week, and we're a little worried that it's going to fall back down, what we do is we load up on those IV reversion type trades so that when the market falls back down, those holdings are not affected. So good to keep an eye there. Good to keep an eye on stock hold alerts because that has a very similar type aim but provides some good information as well. So looking forward to those for the coming week. But that's about all we've got, right? It's been a very, very successful month so far. We've talked, endlessly about the mistakes we made in January. But the only thing we could really do when we make mistakes in the market is try our best to learn from them and do the best that we can moving forward from that point in time. Obviously I'd love a time machine. I'd be a very rich man if I had a time machine. But we can't go back and undo what we did in January. It does provide a little bit of, affirmation, you can maybe say, about our strategy. When you look at our performance since inception, we've done stupid things. This was really, really dumb. This was bad. This was worse, but this was bad as well. But even though we've made two big mistakes since we've been publicly tracking in July of 2020, we're about to hit the 2-year mark on when we've been publicly tracking our performance against the NASDAQ and the S&P 500, and we are, nearing 100% outperformance against these indices. A little ways to go to get to that number, but, we've survived. A lot of people in 2021 made money. I'll be the first to tell you. We made 110%. It was fantastic. But a lot of people made money because the market went up 9 out of 12 months during the year, and of those 3 red months, none were worse than 1.41%. 2021 was the market on easy mode. Anyone could have made money in 2021. But I think what really defines our value as traders and really puts our strategy to the test is how we survive this. When things really start moving against us, where do we sit? How do we blow our account up? Because if you're making 110% a year, you're taking on a decent bit of risk, but I think we do it in a smart way. And we've started to build back up, and potentially I think we could be pushing all-time highs by the end of, at least in our account, not in the overall market, but I think we could be returning to all-time highs by the end of the year. What we love to reference with 2020 is that from July forward, when the market was good, it rebounded 13%, which I don't think would be enough to get S&P 500 back even on the year even. But even if the market went up and still finished red but bounced 13%, we made $38,000 on less capital than we currently have. So if we make $38,000 again, we're finishing the year with a profit of $10,000 and the market would be down 4% for the year, which I think is a fantastic win. We're in the driver's seat right now. We are ahead of SPY. We are ahead of NASDAQ. We have light positions going into Monday. We're going to be very, very reactive. So important to stay tuned to the Discord server. If you want to join the premium chat, that's where a lot of the action happens. Go to hourglass-trader.com and you can sign up for it there. But until next time, thank you guys for joining us on another weekly stream. I'm super excited about where we are in the market. I didn't think I'd be saying I'm excited about where we are if we were losing $28,000 to this point, but being down 15.66% year to date in this market is I think it's definitely an accomplishment, and we should pat ourselves on the back for getting to this point after how dire things looked after the first few months of the year. We've hung in there. It's been a historically difficult market to trade in, but we're alive, we're breathing, and that's the point of our strategy, right? The point of our strategy is that we can live to die another day. And if we, if we spend enough time, moving our cost basis down and continuing to lower these trades and just following the strategy that we have put into place, things are going to come together eventually. For example, DraftKings, right? We've lost a few $1,000s on it, but we followed the process, right? We've got our break-even price almost down below 15 a share. Open Door, we didn't run into too big of a disaster, but again, a 20% drop is nothing to sneeze at on the stock, and we're on track to come out on top. SoFi, 34% drop. Even less of something to sneeze at right there. And that's $1,000 of profit. But having a strategy that allows you to make profit when you see drops like this is how you're going to succeed long term. It's fantastic we made money in 2020. It's great we made money in 2021. But what I'm worried about is what we are going to do long term on a 5, 10, 15-year horizon. And I think these are the strategies that we're going to be able to lean on to give us success. So until next time, this has been the Hourglass Trader, where as time passes, we make money. Thanks for joining us, and hopefully we can talk again same time next week with more money than we have right now. Thanks to Dave in the YouTube chat, NT2007. Appreciate you guys. popping in the YouTube chat there at the very end. And thanks for watching. We will see you guys next week and in the Discord server if you are with us in there. So there you go.